Our first presenter is Sherry Henning. As controller for CSH's Managed Services team, Sherry's extensive background includes annual and single audits, financial reporting, financial leadership, budgeting, forecasting, grant and contract management, and federal, state, and local government funding. Sherry specializes in the not-for-profit industry with over 30 years in accounting and 25 years in not-for-profit accounting specifically, as well as experience in manufacturing, consulting services, and government industries. Her not-for-profit experience includes leadership roles for organizations ranging from $2 million in revenue up to $35 million. An advocate and extension of her client's business, Sherry ensures they are receiving best-in-class and timely services to improve their financial position and mitigate risk. Our next presenter is Sherry Sadler. As a director of managed services, Sherry Sadler is focused on education, development, and engagement of the not-for-profit team. She handles resource planning and management of the entire managed services NFP business group, as well as serving our NFP clients by providing CFO-level services. Sherry has more than 16 years of experience working with NFP agencies, including 10 years in public sector employment with the County Board of Developmental Disabilities field as a business and operations director. In addition to serving clients in the NFP space, she also works with local governmental entities and boards. Sherry currently serves as the Vice President for the Court-Appointed Special Advocates of Miami County. She is adept at executive leadership, professional development, long-range budgeting and forecasting, cost containment, and strategic planning. And finally, I'd like to introduce you to Max Kraus, a senior manager from our NFP group. I will let Max take it from here and tell you a little bit more about our managed services practice.
Thanks, Allie. And I think people may have got the general idea of managed services, but I did want to kind of further explain that because it's not fully apparent from the name if those aren't familiar with it. It's our practice that's kind of like outsourced accounting, but it also offers controller up to CFO level reporting and analysis. So it's kind of like, a combination of your accounting and finance departments all in one. So I'll be chiming in with polling questions throughout and then questions at the end. So if the listeners, if they have questions, please put them in the Q&A, and we'll try to get to those at the end. So with that, I will turn it over to Sherry Sadler.
Good afternoon, and thanks for joining us. I wanted to give kind of an overview of our topics that we're going to address today. Knowing that we only have an hour on this call, we'll be scratching the surface on some of these items that you all have chimed in and asked us to address. So the first one is understanding financial statements, understanding what your leadership should understand about them, as well as your boards. Organizational budgeting, grant budgeting and how that ties to the organizational budget, aligning your financials with your grants, how to account for grant restrictions, and then this was a hot topic this round, using the 10% de minimis or overhead rate. So with that overview, I'm going to get started, and the first thing that we're going to address is financial statements. So there are really two major reports that you and your board should understand that will give you a good idea of the financial landscape of your organization. The first one is the statement of financial position, and the second is the statement of activities. So the statement of financial position, you might also know that as the balance sheet, but in the not-for-profit world, it is called the statement of financial position. And that shows your equity and your liability, and that equals your assets. So what you own minus what you owe is your overall worth. Secondly, the statement of activities, also known as the income statement or potentially the profit and loss statement, that you might be more familiar with. It shows your income minus your expenses, and then that equals your net income. So did you spend more or less than what you've earned? And then the net assets tie these two statements together, but we'll talk about that more in just a little bit. I'm going to walk you through what I like to call the ABCs of the financial statement. It's just an easy way to kind of remember and identify the things you should be paying attention to as you're looking at your financial statements. So A is going to stand for assets. So your assets, the size and the makeup of those assets are one of the most important numbers that you should know about your nonprofit. And you can find this information on the statement of financial position or the balance sheet. And it defines your size, and you can also measure yourself against other organizations like you by looking at that number. And it's used as an indicator of cash and liquidity, investments, how much you're owed by donors or by funders or even customers in fee-for-service situations, and your fixed and depreciable assets. So if you take a look at that asset number, you can ask yourself, does this seem healthy? How are these assets made up? Are they liquid or are they fixed? Your leadership and board should know and understand this in detail to really make good decisions from a financial perspective for your organization. So the B is for budget. So why do we budget? And then when do we budget? Budgets tell where your money is going instead of where your money went. Your budget can be found on the statement of activities or the income statement, or the profit and loss, it's also called. It's important to understand the big picture that makes up your budget. So is it balanced? Do your revenues equal your expenses and you have a zero at the end of that when you look at that report? Is it a surplus? Are you bringing in more revenue or anticipating bringing in more revenue than you'll expend? Or is it a deficit, which is just the opposite, where you're spending more than you might be bringing in revenue? But it's also important to understand some other key elements as well. So one thing to understand is, how are you performing against your budget? So your budget versus actual is a good report that will show you that. Is your budget set up to capture timing of large revenues or expenditures, or did you just spread it equally across 12 months in 1/12 increments? Either way is acceptable, but just understand that you may have to explain variances to your board or your funders if it's just spread equally. And then when is amending your budget necessary? That's something that each individual organization decides on their own. There's kind of no black or white there, but just something to consider. A nonprofit that can budget effectively, again, will be successful in telling its funders and stakeholders where their money's going versus where it went, which is oftentimes what we get from funders. Where is this money going to go? So that helps you to easily identify those things and report that. So now the C is change in net assets. This one might not be as familiar to you, but it's kind of the not-for-profit's way of saying net profit, or really just revenue less expense. So this measures how much you're adding or subtracting from your reserves every year. There are some options on how to show this number. For example, some nonprofits show the change in net assets before depreciation. So you're just looking at cash items, since depreciation is a non-cash item. Again, that is up to your organization and how it's best reflected for you. A key element to consider when reviewing the change in net assets is how well you're doing versus your budget and versus the prior year. These are some questions that we often get from board members. They want to have a greater understanding of the financial health, so they ask those questions. You know, why are we ahead of last year, or why are we behind last year? Those are good things to consider before you report to your board. The change in net asset appears both on the statement of financial position as well as the statement of activities, and it really just ties those two together. So knowing these three elements of your financial statements are the first step in understanding your organization's financial condition, and it better prepares you to create your organizational budget, which is what we're going to jump into now. So where do you even start with a budget? I recommend starting with your revenue, so you know how much you have for your expenditures. So when you begin to prepare your budget, the first thing that you want to consider is what numbers do you know? What's a guarantee? Do you have funders who have multi-year pledges? What are those guaranteed sources? Are there revenue sources that are fixed that you can easily identify? Do you anticipate any decreases in funding? Have you been alerted to that? Any of you who may take part in the VOCA funding, you know that there has been discussion and talk about a reduction in those funds. So those are the type of things you need to take into consideration when you first start preparing your budget. What are you aware of? Next, are you planning to diversify funding sources? And if so, how will you add new funders? Do you anticipate that those funders to be grants or individual contributors or donors? And then what's the estimate for that new funding? Next, what's expected? This is where you may want to review some trends from past years to set your expectations for revenue. Have you seen consistently funding areas decreasing over the last few years? You can consider that as you build out that revenue budget. So once you pretty much have all those numbers solidified and you feel really good about where you are, then you can start your work on the expenditure side. So again, some questions to ask: what is known on the expenditure side? Personnel is often the biggest portion of the budget. So what are you looking at for personnel increases for this year? Is it going to be a cost of living? Is there additional increase above and beyond that you should be considering? And then promotions. Do you have people slated to be promoted that are going to require additional funding? What about benefits? What are you anticipating your benefit increase to look like? What about your health insurance? Oftentimes you won't know that until maybe the fall or even later. And if you're budgeting now for a fiscal year end as June 30, it's kind of a challenge to determine that. One way to do that is maybe to look back at trends again and be able to determine or at least estimate where you might land for your benefit increases. Are you going to have any new positions or eliminated positions? Are there positions on your table of organization that aren't relevant anymore that can be switched into something new, promotions, any of those kind of things? And then we switch to the program side. What program related expenses can you identify? Do you have any new initiatives that are slated? Will there be grant funds that pay for those initiatives? But if so, what are the costs anticipated? They need to be reflected on that expense side. Then think about your recurring expenses, your occupancy, rent, utilities, liability insurance. Do you sponsor any other not-for-profits? Do you have scholarships? Those type of things. Obviously, the expense side, there's a lot to consider. Do you have a plan for equipment maintenance or replacement? I highly recommend creating a replacement schedule. Look up the useful life of anything from a laptop computer to your HVAC system or your roof to begin to plan when they're going to need repair or replacement so that you're well prepared for your budget, maybe putting money aside every year to cover those expenses. Then you have fundraising expenses. Are you having a big event this year that you need to plan for? Are you going to do mailings? Are you going to do anything like that you need extra funds? And then are there other things to consider that are specific to your organization's mission? Once you have all these pieces put together and in a draft, it's time to look at your bottom line. Now, what type of budget did you create? Is it a surplus budget? Are you bringing in more revenue that you can then roll over into your reserves at the end of the year? Is it a deficit? Are you going to have to tap into those reserves to pay for your expenses? Or is it balanced? Is it just a zero balance, the same in, the same out? And what type of budget will your board and funders expect to see? If there are gaps and it's a deficit spending, how do you bridge them? Some ideas, find additional funding sources. How will you do that? Will it be grants? Will it be donors? Use some reserve funding. Now, I would say it would be my recommendation that if you're going to use reserve funding, it should be more one-time expenses and not expenses that are going to be long-term, like staffing, because it's a finite amount of money in that reserve. So my recommendation would be, if you're using reserve funding, make it on a one-time or project type thing. And then the last thing, do you need to reduce your expenses? And if so, where? That can be a challenge and it can be difficult conversations to have. So think that through. And once you've considered all these things that we just talked about, update your draft budget as you need to, and then it's time to gain board support. Now, frequently you will go to your treasurer or to your finance committee first, let them vet that budget and ask questions so that you're really prepared and well-versed in your understanding of that budget when you take it to the full board. Be able to answer the tough questions, explain your position, provide solutions and reassurances for any concerns that might be raised by your board. Next up, we have Max with a polling question.
All right, the first polling question: how accurate is your organization's budget? A, extremely accurate. We live and breathe by our budget. B, somewhat accurate. We may have some variation throughout the year, but we usually end up close to where we anticipated. C, not accurate. We create a budget because we are required to, but it doesn't represent our actuals. D, what budget? So Sherry Sadler, where do you think people will come in on this?
I think budgets and the work that not-for-profits do vary so much throughout the year that I think probably people are going to land on B. Like, we tried to put it together to capture everything, but things happen and you know, we're close, but you know, not exactly perfect. So B would be my guess.
Okay, we'll give it just a little bit more time, trying to have everyone respond if possible, if they're trying to receive CPE. We're about 70%. All right. Well, you were right. 82% with somewhat accurate. And then Sherry Henning, take it away.
Yes, thank you. So I'm going to start talking about grant budgeting. So revenue for nonprofit organizations are typically made up of a variety of revenue sources. Grant budgets and grants are just one of those sources. Grant budgets are used for programs or projects for a particular purpose. For example, capital projects for buildings or program expansion or a new program are a couple of examples of what grant budgets would be used for. Since grants are designed by the funders design how they want the proposal. So it's always best to reach out to your grantor to ask allowable questions to meet their desires in the proposal process. Oftentimes they will have a Q&A where they offer that up to you to ask those questions. I would definitely take advantage of that. So these grants consist of direct and indirect costs, and we want to look at how do we approach the grants with the organizational budgets. And let's take a look at our next slide. Okay, so what are direct program costs? Costs are costs for a particular program, such as print materials specifically for programs, or program staffing and benefits are types of direct program costs. And what are indirect program costs? These are shared costs that are used across programs such as office space, administrative staffing and benefits, copiers, and other shared type of costs. So we will talk more about indirect costs towards the end of this presentation. Let's look at the approach in identifying direct and indirect. The organizational budget consists of all grant budgets plus other revenue resources. So grant budgets often help build or are integrated with the organizational budgets. Aligning these two different budget types help the organizational budgeting and grant reporting. Why not add more cost to the organizational budget? So here are some things to consider as you pair the two. Are you covering existing expenses, or will more expenses be incurred with this proposal, or is it a combination of both? How does this impact your bottom line? Be realistic with the new grants impact your financial statements. Is it increasing your revenue or maintaining your revenue? Is it changing your net revenue or bottom line on the statement of financial activity or your income statement? So revenue is important to understand the difference between covering existing expenses versus additional expenses. It's important to know the difference for not only your cash flow purposes, but to know if you are exceeding your approved organizational budget or if your new grant revenue is netting out with the new expenses. Aligning financials for grant submission. These are other questions or things to consider, and we will take a look at more in a moment. So now we know what we need from the grant. What is next? How does this go with the organizational budget that Sherry Sadler went through? Budgeting categories for grants and organizational budget and multiple grant budgets. Aligning budgets with grants. Budgeting line items compared to grant budget line items is helpful to keep them aligned for reporting purposes and to make sure you have two budgets working together. You have your organizational budget, which can be very different than your grant budget. Or the organizational budget is mostly general ledger accounts versus grant budgets are more category. Mapping the two makes it easier much later as you're doing your reporting. Be specific in category alignment. Match your GL with your grant categories to make reporting for both the grants, audits, and management easier. Multiple grant budgets. It's very normal for nonprofits to have multiple grants, and mapping those two makes it also easier, become consistent. So consistency in approach is helpful to be able to compare various grants for reporting and for organizational purposes. Using the same pattern across grants allows for easier organizational budgeting later. Create tools in your accounting system or Excel or software to help manage between the two. Grants covered for multiple programs. One word of caution in this with multiple grants is no double dipping. So 2 grants are not typically allowed to cover the one expense. So you want to match 1 grant for 1 expense. And I'm going to leave it off to Max to ask our next polling question.
Thanks, Sherry. I could say from an auditor standpoint, your slide on making sure the accounting records and accounts, your general ledger, align with grants, new grants, and assisting with that tracking. I think that's a very key point that you made there. So, but I will read the next polling question here. Do you currently or have you considered outsourcing any part of your finance department? And I should have mentioned too with the last question, there's no right or wrong answer. I think by CPE requirements, we're not, you can't have a right or wrong answer. So just curious here, A, we have a partially or fully outsourced finance department. B, we have considered this option, but would like to understand the logistics. C, we have not considered this option, but would like more information. Or D, we're happy the way we are. We would not consider outsourcing any part of our finance department. So we'll let those kind of go through, give people some more time to respond.
And also, if you are interested in CPE, just make sure to remember to participate in 3 of the poll questions. We do have 4, so there is sort of a bonus one at the end, or if you missed the first one, you will have, there are 3. So this is the second poll that's up, and then there will be 2 more. So feel free to participate in all 3. That just makes getting your CPE much easier.
Oh, well, that's good. I think I saw where a couple of people had technical issues with the first question and being able to answer it fast enough. I know sometimes if you have it up on one screen and it, you know, kind of clicking around makes it, can take some time. So. All right, we have the results here with 30% A, partially or fully outsourced, already have it, or D, 56%. Not considering it. So with that, Sherry Sadler, I believe you are the next section.
Yes, thank you. So we're going to talk a little bit about accounting for grants. Now, what I'm going to talk about is specific to GAAP requirements. So if you're not GAAP, you can still listen, but it, you know, just for things to consider, but it may not impact you quite in the same way. So we're going to start with saying you really just need to know your grants. You need to understand your funding agreements because that's important on knowing how to account for those funds. So because funding is recognized differently from an accounting perspective under GAAP based upon what's required or not required in that grant agreement. So really take some time, read that grant agreement and understand how to account for those funds. So the first kind of grant we're going to talk about is a conditional grant. There are questions to ask yourself about these grants, about these funds. So is there a measurable barrier for you to be entitled to these funds? The key word is measurable. Is there a measurable barrier to be entitled to these funds? Does your organization have limited discretion on how to conduct the activity that these funds support? Do requirements related to the purpose of this agreement go beyond administrative? So what that means is if you're given a sum of money and the only condition is that you report on how that money was spent, that is not what we're talking about here. It goes beyond that. That's an administrative condition that does not count. For example, are there specific outcomes or outputs that are required to receive these funds or to be eligible for these funds? Is there a specific level of service? An example would be a food bank is required to provide 1,000 meals per month, or there could be a match requirement that would constitute a condition. So if yes to any of those things, this grant's conditional. The revenue should be recorded as deferred on your statement of activities upon the receipt of the notice of awards, okay? Or the receipt of funds, whichever one comes first, and recognized as revenue as the funds are spent on those conditions. So you're going to defer that money on your statements and you're going to recognize it as revenue as you begin to meet those conditions that are put into place. Funds can also be restricted. So you need to ask yourself these questions. Do restrictions exist that limit the use of these funds? If there are the restrictions permanently limiting? So for example, a major donor gives $1 million to an organization, but they require that you put that money into an endowment. That permanently limits the use of those funds. So that's a permanently limiting restriction. There can be time-bound restrictions. So you might be given money to fund general operations and programs, but it has to be spent in 2024. So that's a time-bound restriction. They can be use restricted for a specific purpose or a specific program. So for example, donor X gives a donation specifically to purchase books for a library. That would be a use restriction on the purpose or the program. If yes, these are restricted and should be recorded under restricted revenue or temporarily restricted revenue on the statement of financial position as appropriate, whichever one's appropriate, and recognized when the guarantee of funds or the notice of awards is received. As the restrictions are met, the funds are then released from those restrictions into unrestricted revenue. So there's just slight variances between conditional and restrictions. That's why it's really, really important to understand your grant agreements. So then we have unrestricted funds. What do we do with those? If funds don't fall into either of those categories, they're considered unrestricted and unconditional. And that means they're fully recognized at the time of receipt of the notice of award as unrestricted revenue. You recognize the entire amount at that point in time. So for example, corporate donor Y gives you $1 million to be used for operational expenses of the organization, and funding use should be reported annually until that money is fully spent. So there is a condition, but that condition is only administrative. So therefore it's not a conditional grant. And then there are no use limitations, no time limitations. So therefore it's unrestricted. So that needs to be recognized at the time of the receipt of the notice of awards. Fully recognized as revenue. We are going to go into our next polling question, Max.
Okay. How well do you understand grant revenue recognition? A, I know and understand how the different types of grants should be recognized. B, I have a good idea about how recognition works, but I revisit the rules when I get a new funding source. C, I struggle to understand the differences between the grants and how to recognize those differences from an accounting perspective. D, this is all very confusing. I would like to have further information. So we'll give those some time to come in. About 50% responded. Again, no right or wrong answer. You're not graded here.
Max, Max, is this an area where you feel like people do have a lot of understanding? Or Sherry, if you have any thoughts on this, or if this is an area that people find pretty confusing?
I think this is frequently an area of confusion. I think that it doesn't always seem black and white when you're looking at these grant agreements of how it can be perceived. I think each organization can sometimes look at things differently. So it is a very challenging thing. And I think even on the audit side, it's a challenging thing that they're seeing challenges with their clients as well to understand how this works.
I would say this is an area where if we are performing an audit that has probably the most adjustments that are proposed because of the nuances of some of these different grants. And, some of the organizations really have to diversify in a volume of grants. So there's not, some instances, not just one main grant that's sustaining these organizations. They have a lot of different grants that have all different restrictions or conditions that may need to be evaluated. And it's not always readily clear what they are. Sometimes it's going back to that initial grant application. What did you say you were going to do? Are there conditions there? Looking at the award and understanding, Sherry, like you were saying, what is the difference between a condition and a restriction? Because a lot of times it's restricted, but you recognize the revenues all at once, which is where people in the for-profit industry don't really understand the not-for-profit financials, because revenues, contributions don't always match your expenses going out, where you have grants that come in that may be restricted for a specific purpose, and you recognize the contributions one year, but then you're spending the funds on the expenses the following year. So you kind of get this this offset a little bit. But really going through your grant agreements is incredibly important to be able to record them accurately.
All right. Well, let's look at or go ahead, Sherry. Sorry, go ahead.
I was going to say to Max, that's exactly one of the things that I look to first, is look at all of your documentation from the proposal to the grant agreement, the award, and then, you know, ultimately the funder behind all of that. But it's really important to look at all of those pieces, because that is, I think, one of the toughest things with nonprofits is the revenue recognition.
All right, let's go ahead and see kind of some of the results. So Max and Sherry's, I'll let you guys kind of talk to some of the results here.
I think
kind
this
of
is
sorry. Kind of what I expected with I kind of understand this, but I have to revisit. I will say, don't feel bad about that. We do this every day for multiple clients, and once in a while we have to go back and revisit, because it's just so nuanced. So I am not surprised by that being the heaviest answer there.
Yeah, I think that's very, very promising too, to see people generally understand how their grants operate and should be recognized. So that's a good sign.
Max, there was a question that came through, and I thought maybe Sherry Henning would be really great to answer this. I'm sorry, Sherry, to put you on the spot. So a question came through about recognizing it. Oh, I think I lost it. Oh, there it is. If you're awarded a grant, so it says, if we are awarded a grant, we record the revenue. And when we record the revenue when we get the award, what would the balancing entry be for the receivable? And then when are the funds received? We would book the cash and then offset the receivable. Is that correct?
Well, if you get awarded the grant, it would be your accounts receivable and your revenue, right? And what's the other question?
And then it said, would the balancing entry be a receivable?
But yes.
And then when the funds are received, yes, you book it to the receivable.
You book the cash, cash and receivable. Then you're debiting your cash and your receivable. Yeah, so yes, that's exactly right. I had to go down and look, find the questions. Is there anything else?
Yeah, we can maybe follow back up on grants a little bit more when we get to the Q&A, but I'll go ahead and get it over to the de minimis slide.
Okay. Perfect. Okay, de minimis. This is one of the big questions of the day. It feels like de minimis and the overhead rate. Remember, I was looking at the direct and the indirect cost, and this slide is all about those indirect cost options when you're doing your grant proposals and budgets. So as a reminder, the indirect costs for your grants are your overhead costs that are not directly serving your programs or projects. Again, what does that mean? That means that's your administrative staff, that's your rents, that's your copiers, that's your postage machines, that's all of the shared resources or your overhead of your organization. Basically, there are three options when you're doing your grant proposals and looking at those shared costs. We have the de minimis rate, and the current de minimis rate is at 10%. So de minimis is a straight rate that can be added to most grant proposals to cover indirect costs. Basically, it is 10% of your direct costs of the program or project you're proposing. There are some restrictions or limits that apply to the de minimis calculations. So I just want to put that out there, that it is something to consider when you're looking at these things. Very recently, and I know we sent an article out on this. Very recently, the 10% rate was announced that it is increasing to 15% for October 1 of 2024. I do know through my managed services, work here, that we have had a couple of funders or grant proposals that have allowed the 15% de minimis rate to be in the application process. So if you're proposing or looking to do that, I would ask your grantor if that's an option. So indirect costs, overhead rates directly in grants. We have line item expenses. You can use line item expenses in grant proposals or budgets that are directly identified and can be included in your proposal. These would be managed with your grant. So that means a specific, say you want to put your rent or a portion of your rent in this proposal. You can do that, but you have to be very specific when you're talking indirect costs that are line items. Very specific expenses, copier lease, and things like that. The third is the negotiated indirect cost rate agreement, the NICRA. It's much easier to say. So this is to apply to the government through an application process to be approved to use a negotiated rate for government grant purposes. So you go through, you actually have they have a very distinct process to do that you follow through to show what your overhead rate truly is for your organization. And you negotiate that with the government. Once you get a final approval, that is when you can use that for your grant proposals, and you would submit that approval letter or award of the negotiated rate agreement in with your proposal. Okay. Once approved, you will receive the process going. You will use this NICRA process going forward. What does that mean? That means you cannot keep going back and forth. One year you want to use the NICRA, and the next year you want to use the de minimis. So the government doesn't like you going back and forth between different systems. If you want to approach the negotiated indirect cost rate method, I would look at those different options and what that means. The other thing is you do need to apply each year and identify the period, and that is approved and covered by the rate. I do have some benefits or downfalls associated with each of these three. De minimis is low maintenance in that you aren't sending in a full application like the NICRA rate, or using category line items for each grant that you will have to track very carefully. It doesn't typically cover all of your indirect costs for an organization. Indirect costs directly in the proposal brings you a very distinct determination of what is being covered. It can be pretty restrictive. One of the other downfalls is if a cost goes up that you've put into the proposal, once you've submitted the grant, most times you would have to either go and do a budget adjustment, or you might not be able to cover that full expense. For example, if you did a copier expense or a partial of the copier expense that you thought would be used for that program, you would, and that copier increases for whatever reason, you would only be held to what is in the actual grant. NICRA, I've already sort of alluded to this. The rate option is often a bit higher than the other two options, and that's one of the big benefits with going through this process. It does allow for more overhead costs to be covered across the grants. The downfall of that is it can take a bit of a process and time consuming to put the application together. And even in the negotiation part of the process with the government, it can take a bit of time. So those are the three options that I have for the de minimis and overhead indirect costs related on grants. We're at the questions portion.
Okay, I think we do have a good amount of questions in the chat. So I do want to add in with grants, we're talking about conditions and restrictions. Also looking at the funding source is important. You know, if it's federal dollars or local or state, kind of where it's coming from. Sometimes it's not always clear, and the grantor may not always know if it's being passed through another source. But identifying those federal dollars is important to make sure if you are under any sort of single audit requirement.
Absolutely.
But, let's see. So I have a question here. What formats of financial statements have been helpful for the board to understand the organization's financial landscape?
I think I can take that one. Like I said before, the statement of activities, the statement of financial position, those are helpful. And sometimes it's helpful for just a board quick view perspective is to put together a dashboard of some type where you can see those, the assets and the budget and the revenue, all those things very easily, and maybe even in a graphical way that will help someone quickly be able to understand what you're talking about. And again, there's no better way to represent it than to talk through it and to answer the questions individually. And Max, if you don't mind, I wanted to clarify, there was a question on the conditional grants. That is correct. About conditional grants, you put them as deferred revenue. That's exactly right. As it was shown in the slide, they're deferred revenue for conditional grants. And as you meet those conditions, that's when you recognize the revenue. The question that we got earlier didn't specify if it was about a conditional grant or not. So just to clarify, that is correct. For a conditional grant, you would record that as deferred and recognize the revenue as those conditions are met. So sorry, I just wanted to answer that one as well.
And then I have another question here. How popular is it to calculate an indirect cost rate with your clients?
I don't know of any of our clients that currently have that. I've done that in my past quite a bit, but currently our clients have not elected to use that. Most of our clients, or most of my clients, use the de minimis.
Okay, and well, so Sherry, maybe you can speak to this question as well. How many funding agencies are likely to allow for a calculated indirect cost rate rather than utilizing the de minimis rate?
I think the de minimis rate tends to be so easy to use and not as cumbersome that it often becomes a fallback. I'm not sure about a percentage, to be honest.
Okay, well, I'm kind of going down in the de minimis line of questioning here. There's another one.
Okay.
If you're ready. In the absence of a directive either way, should we return any unspent de minimis indirect funds?
Oh, that's a really, really great question. So the even choosing the de minimis 10%, you still have to have costs that cover overhead costs or indirect costs that cover that 10%. Oftentimes the grantors don't require you to report exactly what makes up that, but many times in audits, they will make sure that that 10% was covered appropriately by the grantor, to be spent.
All right, I'll let you off the hook for now. I think maybe one for Sherry Sadler here. What is, Sherry, here's a question here. What's the typical kind of month-end close timeline for a not-for-profit? I mean, is it a matter of days, weeks, months? I mean, what do you generally see?
What I can tell you is the sooner the better. You want your information to be fresh. Even if it takes 2 weeks into the next month, you're already 6 weeks from the first of the month that you're reporting on. So internally in our managed services department, our goal is to have every company that we work on closed in 10 business days. So that's heavily dependent on the complexity of the organization. Sometimes we can have a company's closed on day one. Sometimes it takes past beyond that 10-day close. But the sooner you can get those results reported, the better your organization is prepared to make financial decisions that in the month you're in. A good way to kind of keep that more up to date is reconcile your cash and your transactions on a regular basis and not just at the end of the month, because that facilitates really that reconciliation process at the end of the month. Keep your records up to date as much as you can to just kind of facilitate a smoother close, because again, taking too long to report on that stuff, just your data becomes stale and you may have already made decisions that could have been impacted by the reporting that you had, a month ago. So all I can say is as soon as you can get the data and the time to get it done, it should be a priority at that first of the next month.
Yeah, absolutely. Okay, does the no documentation is required to justify the 10% de minimis cost rate, this is from the CFR, phrase mean that an entity is not required to submit supporting documentation on indirect costs for reimbursement on a grant?
Yeah, so sort of back to that, while it may not be required to submit that documentation to the grantor because of using the 10% de minimis, and for auditing purposes, you're going to want that documentation to verify that you truly did spend the 10% appropriately. I have seen auditors ask for that confirmation.
Okay, and then this question kind of goes back to the analyzing not-for-profit financial health and reporting. And what are the main differences we should look for when analyzing financial statements of a nonprofit organization compared to a regular business?
I can jump in here. Revenue recognition is a huge one, obviously. The grant recognition, restrictions, contributions, fee for service, all of those things. The naming conventions are different. So your reports, like we kind of went through in the beginning of the webinar, the names are different for your reports. The names are different for some of your accounts. So net assets versus equity, those type of things. And then another thing that is pretty prevalent for not-for-profits is your functional expenses and categories. Kind of keeping those things aligned because your funders and your grantors want to know how much you're spending on administration versus program versus fundraising. And so those are other things that are really specific to the not-for-profit world.
And then is it recommended to aim for a zero balanced budget, so $0 change in net assets budget every year? Or are there cases where a board might approve a budget surplus or deficit, and when might that be appropriate?
Absolutely. Again, all of this is very nuanced for your situation. I can give you an example that we had a client a while ago that had a pretty decent sized reserve, and they kind of were on a spend down situation where they needed to have a deficit budget just to get into those reserves. So in that case, the board did approve a deficit budget. I think the most important thing when budgeting, whether it's a deficit, a surplus, or a balanced budget, is that it's realistic. you want to try to use that as your guidance for the whole year. You don't want to set ridiculous expectations that you're just not going to meet, or slim down your expenditures so far that you can't, move forth your mission. So the most important thing is that it's realistic. Your board may have opinions and may have thoughts, and you may have to adjust what is realistic to fit those expectations. You might have to cut funding somewhere, or expenses somewhere, or something like that. But I don't think there's a right or wrong answer to this. I think there are so many variables that go into that. So really just considering what your board and funders are expecting, and what's realistic.
And then Sherry, I have another question for you. It's how do you estimate when you're putting together a budget, maybe grants that haven't been awarded yet, and trying to factor those in?
It's a great question. So if you're looking at operating dollars, or I think it's different based on if it's something to specifically fund a program, you need to know how much that program's going to cost to be able to estimate. You can look at the history of that organization. You can talk to other people who have received funds. You can just try to estimate what you need for a specific project and go for that. And if it falls short in that funding source, try to partner with another funding source as well. Sherry Henning, do you have any thoughts on that question as well?
Yeah, for the funding sources, you mean, to cover? Say that again.
So how do you budget for grants? How do you estimate if you don't have that grant already? How do you estimate for your budget?
If I'm looking at, typically when you're looking at budgets, you're looking at your revenue sources first, and the grants tend to be one of those heavy ones. A lot of times, certain ones are coming in, you think some are probably coming in, and then you got this other pool of grants that may or may not come in. And you have the pool of grants that are out there that you don't even know may apply, or to even put on your budget schedule for budgeting. You can do percentages. You can do the 100% for the ones a certain percentage for the ones that you are likely to receive. And then maybe there's a smaller pool that you think you can fill, or a bucket you can fill for those other grants, or we always call them the unknown grants. And that's one method of budgeting for the possibilities.